Now here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meets. Coming up, no more charging dead people, no more fee for no service. The ABA's Bligh gets in ahead of the big bank CEO political grilling in Canberra tomorrow, changing the banking code. Will that end will that and nearly $2 billion in remediation for customers make amends? The biggest company you've never heard of, our exclusive interview from New York with Zia Chishti, the businessman now in his third billion-dollar business that makes billions for clients from pairing employees and customers. And I talked to Origin Chief Frank Calabria about the government's new announcement today to drive energy reliability and what he thinks of all the big stick bandit rhetoric coming from Canberra. Now, just on that, the NEG is not dead, apparently, at least not dead, buried and cremated dead. That was the big message from the AFR Energy Conference today, with Energy Minister Angus Taylor calling for a mechanism dealing with energy reliability to be agreed by Labor and all the states.
A retailer reliability obligation will encourage investment in dispatchable generation that delivers when you need it, in the right place at the right time to ensure reliability in the NIM. I'm committed to working with the states and territories through the COAG Energy Council to progress the implementation of the retailer reliability obligation. This is one of the highest priorities of the Commonwealth.
Well, in principle, Labor has accepted this idea, which in a way is pretty extraordinary. Now, remember back to the NEG. Can you imagine Labor giving any ground on the dispatchable or any energy security side without a commitment on emissions? Just on emissions, though, the two sides remain poles apart. The government is sticking to its 26 to 28% emissions reduction target by 2030, which now looks achievable without too much sweat, actually, but Labor's sticking to the 45% mark. Energy policy has created anarchy in the marketplace, according to veteran business leader Kerry Schott, who was there today. She chairs the Energy Security Council. Why did she say this? Well, many reasons, I think. The policy vacuum, which means investing, which could bring down prices, is very wobbly. The really bumpy job we've been doing with transitioning renewables, take the abrupt shutdown of Hazelwood Power Station, which bumped up prices. What became clear to me today is that a smooth transition is actually getting trickier. That's because the huge increase in renewables, wind and solar, which can produce power during certain times of the day at almost zero cost. What is it doing? It's effectively hollowing out the business of traditional coal or even gas power stations. So while we've just seen the dire warnings from the IPC climate change report and almost all the existing big coal power stations will be closed by 2050, they might actually be shut down long before their technical operating life because they can't make money. Great to say the Greens, but the problem is making sure you have enough what they call firm or secure energy available 24/7. Well, another tricky development is the incredible take-up of rooftop solar, which the energy market operator boss Audrey Zimmerman put at one new home every 6 minutes, all thanks to falling production costs while government subsidies stay high. Again, it sounds great, but try to organise a national grid with the rise in behind-the-meter energy that wants to start putting back energy into the grid and all at the same time keeping us energy secure. Add to all of that two big sticks that the Energy Minister, Angus Taylor, and Resources, i.e. Gas Minister Matt Canavan, are waving around, goading business to bring down electricity bills for us all. There have been threats of a royal commission into energy and cries of bandit behaviour by energy companies that hide behind complex power bills and been caught out charging so-called loyalty taxes for customers that don't shop around. Frustration around a lack of proper energy policy was really evident, I think, in every speaker today. Kerry Schott, whose Energy Security Council was created after Finkel to make the NEG work, quipped that she was going through phases of grief but was still at the anger phase. Well, I'll be catching up with her and Minister Angus Taylor tomorrow down at the Australians Outlook Conference in Melbourne. But interestingly, Kerry Schott did say that the Energy Security Council has not been asked to stop working on an NEG, and they're continuing with that work. Certainly, under a possible Labour government, that would be time well spent. In the meantime, let's hope Minister Taylor's reliability mechanism gets the tick of approval at the upcoming COAG meeting this month. Now, the Australian Banking Association is planning to overhaul its code of practice to ensure fees are no longer charged to customers who've died. The ABA wants changes made to the way banks manage a customer's estate to avoid a repeat of the fees for no service scandal. Chief Executive Anna Bligh is leading the response after describing the Banking Royal Commission's scathing interim report as a day of shame, quote-unquote, for the banking sector. Commonwealth Bank has announced it will refund customers who've been charged fees for no service, including dead customers. CBA, AMP and National Australia Bank have come under fire over the fee for no service scandal. Well, for more, I'm very pleased to welcome CEO of the Australian Banking Association, Anna Bligh. Anna, thank you for coming on.
My pleasure. Good afternoon.
Good afternoon. Now, this is it's a very important day. In fact, is this not all about the timing? You've got 3 big bank CEOs being grilled by politicians tomorrow. I mean, at least they can say, well, look, we're doing something, we've got this in the code.
Well, the Royal Commission brought down their interim report just on about 10 days ago. If you've seen it, it's 1,000 pages, and
yes,
banks have been steadily digesting it, and they have got 4 weeks to respond. So it's a very tight time frame. There are some very complex things on which the Commissioner is asking questions because he's still forming his own views. But there are a couple of standout issues, and the ones that we've made an announcement on today, absolutely clear that they are wrong, they're unacceptable, we don't need to wait for a final...
Why weren't they in the code already? After all, the code was recently revamped, wasn't it?
This, in many ways, is a statement from the industry, and putting it into the code is a way of putting beyond doubt that the industry has heard the message, learnt the lesson, and is seeking to make sure that it never happens again.
But I mean, it was the law. It either should have been in the code before, or, the law should have been abided by, don't you think?
It is never acceptable for any organisation to charge fees for services that are not provided. So it has, as I think the Commissioner put it, it's just plain wrong, and if it's just wrong, then banks should just fix it. This code is the strongest vehicles that banks have to make a very clear statement to the public and to their customers. Banks will no longer tolerate this behaviour in their organisations. The code, I think, is also a very useful vehicle for putting on the record what customers can expect when there is a death. And when you lose a loved one, at some point you will tell the bank, but it may not be the next day. It might take weeks or months.
No, I've heard that from the banks, but the amount of it and the sort of mischief that went wrong.
I'm not saying, I'm just saying going forward.
Yes.
We need to be very clear with customers that if they once they notify, banks will go back through their account, and if fees that should not have been charged were charged because banks didn't know, there'll be a refund because those fees don't belong.
Now, Anna, you worked so hard. I can remember talking to you when that bank levy came down from Scott, Crimea, River, Morrison. Do you remember that? You worked so incredibly hard. Now, that amount that the banks squealed about, it pales into insignificance compared to the remediation costs that they are having to pay now. Morgan Stanley puts it now $2 billion around this fee for no service, and whether that includes AUSTRAC and BBSW, legal costs, the Royal Commission, the NAB ASIC action. I mean, it pales into insignificance. It's just extraordinary and very ironic, I would say.
It is clear that, well, I should say right now, banks are already in the process of compensating customers for fees for no service. They have got some way to go because in some cases they're investigating back 5 and 6 years, but they've already paid out several $100 million. The latest estimate on the compensation for fees for no service across all banks involved in this, somewhere around $1 to $1.4 billion. You're absolutely right, it's an extraordinarily high amount. I think that
it is the amount that customers should have had.
Well, that's right, and it shows you the size of the problem.
Yes.
And I think it's one of the reasons why, the Royal Commission shines a lot of sunlight on a problem, but I think we all know when there is a bottom line consequence, that's a very good lesson about how to conduct yourself.
So the big chiefs, they're heading into a hot hothouse up in Canberra, you know, I've heard Bill Shorten the other day going, you know, the thing I'm asked most often is, why hasn't anybody gone to jail over this? Do you think that's what they'll be asked? That they have to start taking accountability, responsibility right at the top, whether it's bonuses or making sure the appropriate people do end up with criminal charges?
Ticky, banks don't fear scrutiny. They've cooperated fully with the Royal Commission, and they'll cooperate fully with the House of Representatives Committee tomorrow. It'll be interesting. We've got a number of new members on the House of Reps Committee. There'll be at least one new CEO in the mix, so you know, it'd be hard to predict how it might play out tomorrow.
But presumably they're expecting to get quite a grilling.
I was going to say, I would expect, you know, certainly. The CEOs would be expecting, I would think, that issues around accountability may well be raised. Every CEO of our banks, whether they're major or smaller banks, have very clear that at the end of the day the buck stops with them, and that ultimately a change in culture is going to take leadership from them.
Yeah. So they don't, I mean, are they expecting further cuts in their bonuses as a result of this?
Well, look, I'm not in a position to comment on that. Ultimately, that's a question for their boards. But we have seen a number of banks take, or a number of boards take action through their remuneration packages on matters which they thought were unacceptable. But I think what Australians need banks CEOs to do right now is not only take accountability, but in doing so, take the mantle of leadership and use their leadership and the strength of their leadership to really drive a cultural change that will last long beyond the Royal Commission.
What about the regulators? I mean, the Commissioner Hayne did say the regulators had too much of a soft touch. Now, couldn't you sheet back some of that to industry capture and actually the bad behaviour of banks trying to push the idea of always an enforceable undertaking, because actually they knew very well what was going on, but this was an easier way for them to deal with it. I mean, those days have got to stop as well, haven't they?
Obviously, part of the solution to a problem that is about conduct and culture is about the regulatory framework and is about enforcement of the law. One of the things the Royal Commission has identified is that in many cases, in his view, the law may well be in its current form sufficient.
Yes.
The question is, is there a sufficient level of compliance with it? And if there isn't, is there a sufficient level of enforcement?
Well, what about breach reporting? That was an unbelievable report that ASIC came down with the other day. 5.5 years, was it, from identifying a breach to, you know, to actually customer getting the money back. So why isn't that in the Code of Conduct, for example?
Well, that's already covered by legislation.
Yes.
It is already the law.
Well, so is this other stuff going into the Code of Conduct.
So one of the things that we need to do with the breach reporting, I think, is systematically work through. One of the helpful things about the ASIC report was it didn't just say here's the length of time. It said this bit takes this time, this bit. So you can actually go in and start to forensically say, well, how do we shorten that?
And it split the banks up, and some who are more culprits.
And there's lessons there for each bank to learn, and there's potentially more work that could be done at the regulator end as well about how quickly they can do their bit as well.
Yeah.
So I think there's a whole spectrum here of work that has to be done on that. Because I do think Australians are reasonable people. They understand that in big organisations.
Yes, but are banks reasonable companies? That's the question.
The point is, I think Australians understand that no matter what you do, in a big organisation, from time to time things will go wrong. But what they then expect is that if it goes wrong, it'll be found quickly, fixed quickly, and someone held accountable. And I think that's why breach reporting and compensation is so important to re-earning trust, because people do expect, they understand, I really do think, that from time to time things are going to go wrong.
Yeah.
But if the thing that goes wrong is fixed quickly and they're compensated you know, very quickly.
Well, there's a lot of work there on that breach reporting side. Now, look, you also want the government to change the FOFA laws to end the grandfathering payments and trailing commissions on financial advice. Now, the banks, of course, having been supporters of keeping it in the old FOFA legislation when that was going to be mooted to be changed. Now they do want to change it. This is because, presumably, the banks see this coming down from the Hayne Commission, and they want it changed by law, so that they don't have to pay all these rebates. I mean, it's about saving the bank's money, isn't it?
Oh, no, I don't think that would be a fair assessment. This financial reforms were brought in 2013, and it was identified by the government at the time that there was a number of parts of remuneration, trailing commissions among others, that were what they called conflicted remuneration that led to poor customer outcomes, and they were outlawed. But the industry at the time, including banks, but not only banks, but the whole industry said, okay, that's the new rules going forward. Any existing arrangements we should keep, grandfather them, with the view that over time those arrangements would wither on the vine. That just hasn't happened. And 5 years later, you know, the Commissioner asks very tough questions on this, and he's right to do so. If everybody agrees they were they should be unlawful, it is time for the industry.
You think they're gone?
It's time for the industry to say there's no place for these. A number of banks have, not all, but a number of banks have now stopped using those provisions for their own direct employees.
Yes, but as I say, very much more business for the banks is under contract, really. So
there's certainly a lot of that, and it's something that that's why it's so important to customers.
Yes.
If it's not good for a customer, it's not good for any customer.
All right.
And this is about making sure no matter which door a customer walks through, whether they walk through a bank for a financial planner or somebody else for a financial planner, they should be treated in a way that gets a fair outcome.
So a couple of last quick ones. There seems to be a large number of class actions now, and are coming through on the back of the Royal Commission. Are we going to see a more exposure for the banks?
Look, I think that's hard to predict and speculate on. It's not unusual in a Royal Commission for various law firms to test the appetite for a class action. Whether or not those end up in court and whether or not they're successful, you know, is anybody's guess at this stage.
You've got that, and then
but I'm not surprised. I think there are issues here where there are a lot of customers affected, and they may want to take further action.
Yeah, and the other thing I should ask you about is the ACCC criminal cartel case. That was around syndication and in particular in relation to ANZ, Citigroup, Deutsche. Now that's being kicked back to February of next year, but that could be quite a significant case if it goes against the banks.
Oh, I think there'll be a lot of corporate Australia watching this case. Has implications
and it's a criminal case, you know.
It is, and it has implications, I think, far beyond the banking sector, right across corporate Australia. Clearly, it's a matter now before the courts. I'm not going to comment on it any further than that, other than to say I think it will be very interesting.
Well, it sure will. Let's hope there's not another great big thing that you have to deal with on behalf of the banks. Anna Bligh, thanks very much for coming in. We'll watch closely tomorrow.
Thank you very much, Ticky.
Good to see you. OK, well, after the break, the founder of the $3 billion companies. Talk about overachieving. Zia Chishti, founder and CEO of Affinity, next.
You're watching Ticky on Your Money. Now, back to Ticky.
Well, now to a very special interview. To build one unicorn might be seen as good timing. To be in the process of delivering a third. Well, businessman Zia Chishti grew up in Pakistan, and he moved to the US to become a banker, then a management consultant, and then a hyper-successful entrepreneur. His latest company, Affinity, matches customers calling in for advice or help with the best person for them in a call centre, not just the next call centre helper in the queue. Now, it sounds just a small thing, but this pairing is making billion-dollar differences to his super big clients, and it's all done through machine learning, proper machine learning. He's pretty dismissive of the many businesses talking the talk on AI and not walking the walk. His advisory board boasts the chairman of Glencore, chairman of Verizon, CEOs of Sony and BP, a former French prime minister, and many other very important people. Zia Chishti, chairman and chief executive of Affinity, spoke with me direct from New York.
Zia Chishti, it's great to speak to you there in New York.
Thank you very much, Ticky. Wonderful to be talking to you.
Now, Zia, you've got not one, not two, but $3 billion ventures that you've created. The latest, Affinity, you describe as the biggest company that we've probably never heard of. What does Affinity do exactly, and how big is it?
Well, we work for large enterprises. We're not a consumer technology company, which is probably why we're not as commonplace as most. So we hide behind the shadows and optimize how large enterprises interact with their customers. We are about 1,000 people. Our last round of funding was done at about $1.6 billion. We're pushing 9-figure revenues, so we're a bit of a force in the applied AI business.
Right. Now, you say you're a force in the applied AI business, artificial intelligence. A lot of people are using that phrase when they're describing their businesses. How do you use AI?
Well, you touch a bit of a sore spot for us, Ticky, where I think the abuse of the term AI has gotten to such extremes where any company that puts those two magical letters next to its PowerPoint suddenly is able to attract funding from credulous venture capitalists in droves. So I think we are in a bit of a rush at the moment around AI, but I think we're happy to say that we're not part of that rush. We were here approximately 12 years ago when the world was in the midst of what was then called the AI winter. So we've come at it from a bit of a different path. Our technology is basically finding patterns in information, no more, no less. We're not trying to build programmable robots that will take over the world or anything magical or mysterious. It's simply pattern recognition in human behavior. How do people interact with each other, and how can enterprises use that information, use those predictions to change how they assign their enterprise employees to their customers.
Yeah, so if I got this right, so within any presumably very big companies, call centres and customer interface, which is so important these days, what you're actually doing is matching the best type of call centre person with the best with the best fit with the customer. So can you just explain a bit more how that works?
Yeah, that's exactly it. I think if you pull back the lens just a little bit, Ticky, you're looking at a world where enterprises have highly rule-based mechanisms for assigning their employees to their customers. Let's say they have a sales force. They might segment their sales force by geography, Western Australia, Eastern Australia, or by seniority. If you're the senior salesperson, you might talk to the CEO. Otherwise, you might talk to the junior person. So that works, it's effective, but we layer on one more optimization, which is behavior. If you can figure out the behavior of that salesperson and figure out the behavior of the potential customers that that salesperson might get assigned to, then you can optimize that pairing for that concept. And that applies across the board in a large enterprise. You mentioned call centers. That's a big chunk of what we do. In call centers, the rule is first come, first served. So you get a queue of these calls that gets built up. Whoever's the first call in queue will get assigned whatever the first enterprise agent is that comes free. We add a similar level of behavioral optimization. When an agent comes free, we don't mechanically peel off that first customer in sequence. We predict the behavior of that agent, predict the behavior of each of those individuals in the chain, and then pair out of sequence based on behavior. So that concept of optimizing what are rules-based applications of pairing by overlaying insights into behavior and predicting behavior is what we do.
So this is real machine learning, if you will. Now, how do your customers, these big clients, actually see that performance has improved?
Good question. This is another of our pet peeves with the AI industry as it's evolved, where it's very ambiguous as to what economic value any of this actually has. So we were very studious about starting our business more than a decade ago by being very clear as to the value that we deliver. So our process is simple. We run our systems on for 15 minutes, turn them off for 5 minutes, turn them back on for 15, off for 5, do this forever. At the end of every time period, say a month, we would look at the enterprise's performance with our system running and then the enterprise's performance without. The difference between those two samples is what we generate in the way of value, and actually that's how we're paid. So our clients don't pay us any fees, they don't take any risk, they don't make any investments. If we give them a fresh revenue stream or if we reduce their costs in a measurable way, we get a share of that.
So how much does, I mean, it sounds like these are tiny numbers, presumably it's all about scale. I mean, how much can a Verizon or a Avaya, you know, some of your clients, how much can they save using your technology?
It's in the billions. So
in the billions?
We'll talk about Avaya in just a second, but oh sure, yeah. So let's take that Verizon example for just a second. I'll use it as illustrative for the purposes of this discussion. They do about $120 billion a year in value, in revenue rather, as an enterprise, of which approximately $30 billion is mediated from their contact centers. If our optimization is, call it 5%, that's $1.5 billion a year in revenue from us to them. And if their gross margin is 50%, that's $750 million a year in value from us to them. So that's the, in actually pre-tax profit from us to them. So that's the sort of scale at which we operate. Generally, we get involved with enterprises where we can make $100 million a year cash flow difference. And then for larger enterprises, that goes well north of $1 billion.
Zia, what about your other two businesses? They're very different. There's Align and then there's TFG. What are they and how did they grow up?
So Align was my business school project in Stanford way back in '97. It was a tooth straightening company. It was very quirky, but basically it used machine learning, actually robotics and vision, to figure out how to move teeth using plastic appliances rather than braces. Proved to be very, very effective and successful as a business. I took it public back in 2001. Today it's worth $30 billion, or give or take change. So, so that was that. It was a bit of a techie startup in Silicon Valley in heady days back in the late 90s. After '02, I started TRG, which is just a private equity management company. That too flourished. We made a bunch of very, very successful investments. And then out of that, one of our investments was Affinity. That was 12 years ago, and it grew. And then about 3.5 years ago, my two partners at TRG and I sat down, took a vote, and I lost. And I was then made CEO of Affinity. So I've been here for the last 3.5 years in full-time capacity.
So Zia, I've watched some of your interviews around the world online, and you have earlier this year talked about taking Affinity public. It's now September, taking Affinity public this year. It's now September. I'm just wondering whether that is still happening.
Well, our fiscal year is June, so a bit of a smug response, but we'll be done with our fiscal year in June 19. Yeah, look, the markets are very, very strong right now and particularly receptive to messages like ours. Our business is scaling on the order of 100% a year and has been for the last 5 years. We are cresting into profitability pretty much as we speak. So the business is ready to go public. The question is just fine-tuning the timing for valuation, for process. So that's all underway as we speak.
Who are your investors?
Well, first a shout out to many of our friends in Australia. We have approximately $20 million in investment from our friends in the Australian business community. So that's a pocket. But amongst the major investors, my old firm, TRG, owns shade around 50%, give or take, of the company. McKinsey & Company, the large global consulting firm, owns 4 and some. Global Asset Management owns 4 and some, and then there's a long tail of rather illustrious individuals. Well, and of course the management of the company. Speaking
of illustrious individuals, now I know you're very fond of your old school McKinsey as well, but your advisory board is a sort of roll list of business and political leaders. Can you just name a number of them, the sort of people that you've got on there, and why you've got them?
Oh Lord, you put me in a tricky spot because I either have to do all or none, or or risk being partial.
Well, we can list them off, but I mean, yeah, go on, please.
So you mentioned Verizon earlier. Ivan Seidenberg, the former chairman and CEO of Verizon, is a significant investor in us on our advisory board. By the way, we share some DNA. President Jose Maria Aznar is on the News Corporation board, so. I think we are distant cousins, Ticky, you and I, in the broader business community. Admiral Mullen used to run the U.S. military. He was chairman of the U.S. Joint Chiefs of Staff, is on our advisory board. Tom Gloser used to run Thomson Reuters. He's on our advisory board. So the list is long. It represents leaders from the business and the financial community, and this is 20-plus years of my work and that of my colleagues to put together an investor base and an advisory base that really helps power the company's success. I think that's our pocket of advice in this world, and our pocket of guidance in this world as to how to scale the business, and I dare say that it's been the best investment we've made.
Zia, you took a business delegation, maybe more than one, back to Pakistan, which obviously is where you grew up. You feel very passionately about the country. What do you think of Imran Khan's leadership now? Because I think certainly you were very much behind that at one stage.
Yeah, so I was a very early fan of Imran. I funded his very first campaign when he won precisely one seat in Parliament back in Pakistan. Funded is too strong. Contributed to his campaign is probably a little more accurate. He is a very dynamic leader, very successful in politics, as you've seen. I think the challenge for Imran will be, does he build a team around him that can now push his vision forward? Will he have the right group of people that can affect the economy for the better, get the justice system working, focus on health and education, some of the core things that the country really needs to prosper. So, and I think he's going through that process right now. So it's a very exciting time. It's a tumultuous change in Pakistani politics for the previous 2 decades. It's either been the military or the People's Party, which is the progeny ultimately of the Bhutto family, and the Muslim League, which is a progeny of the Nawaz family. So, so I think there's a new face at the helm. We're all very excited, and we're pulling for a success.
Can this help open up Pakistan? Because I know you yourself, when you were, leading a line, your first company, when the Twin Towers happened, that was very difficult time for you because of the associations with Pakistan. Then can this change? Do you think Imran Khan can change how the world sees Pakistan?
Yeah, Pakistan has a very interesting dilemma, which is that the facts on the ground are not supported generally by the global narrative. I think the majority here in the United States, if asked about Pakistan, would have a mental image of a dangerous country or an unstable country with a troubled economy. Neither of those is in fact true. Pakistan is extremely secure and stable. The rate of violence in the major cities is a fraction of those, say, here in the United States. The economy has been growing 4%, 5%, 6% a year now for a long time, putting it in the top few countries in the world. So it's really a question of telling the story better. That's why I took a bunch of people to Pakistan a couple of years ago skiing. It was extraordinary. They really hadn't anticipated that level of welcome, sophistication, economic development, and then to ski 3,000 vertical meters in 20-foot deep powder and virgin slopes. I think that was once-in-a-lifetime experience. So,
well, it sure...
that's the kind of stuff that I think we need to do.
Zia, I was going to say, it sure was for Wyatt Roy, who runs your Australian operation. I think he probably overstated his, well, so he says, his ability to ski. He said he's never seen anything like it in his life. Finally, why did you select Wyatt for Australia, and how is Australia going?
Wyatt is absolutely brilliant. He's one of the most intelligent people I've ever met. In his youth, he accomplished something phenomenal, which is, I think he was the youngest ever member of the Parliament in Australia, and I believe even the youngest ever minister. So he's an extraordinary individual. In his ministerial position, which was leading the innovation portfolio, I think he learned a lot about the kind of things that we do, learned a lot about the way enterprises make decisions. So he was able to integrate those thoughts, and I'm absolutely thrilled that we have Wyatt at the helm leading our business.
Well, Zia Chishti, it's been terrific to be able to speak to you and learn about your remarkable successes. Thank you so much, as I say, for taking the time to talk to us from New York.
Thank you very much, Ticky. Have a great afternoon.
Yeah, we'll keep an eye on that float. After the break, has the energy guarantee risen from the dead? Talking power prices and competition with Origin Energy CEO Frank Calabria.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, the Energy Minister is attempting to keep alive the reliability mechanism in the now dead NEG. Speaking in Sydney at the AFR Energy Summit, Angus Taylor promised to pursue the reliability obligation originally proposed as part of the National Energy Guarantee, even though the emissions reduction component of the scheme has been dumped. State energy ministers will meet later this month to discuss the new package, their first summit since Malcolm Turnbull and his signature energy policy were abandoned by the coalition. But the chairman of the Energy Security Board, the organisation behind the NEG, says the fresh reliability push proves the NEG isn't quite dead yet.
While people have declared the NEG dead, it's a bit premature, I think. Certainly the reliability part of it is still alive, and there is legislation ready to be put into the South Australian Parliament once the COAG Energy Council agrees.
Well, I caught up with Origin Energy CEO Frank Calabria, another speaker, on the sidelines of the AFR Energy Summit, talking Australia's competitive advantage in energy.
Frank Calabria, great to catch you down here. Now, I suppose the big news today is that the NEG may be dead, but reliability is very much back on the table.
We're supportive of the reliability mechanism that was originally contained within the National Energy Guarantee. And the reason we are supportive of it, and I think it'll get broad-based support, is that it really sets a reliability obligation on retailers for any level of new emissions, low emissions, intermittent renewable technology coming in. We need to match it with a reliability obligation, and so that's an important feature when we have a market that's rapidly transitioning towards intermittent renewable energy.
Kerry Schott said today we simply can't get the government and the opposition to agree around emissions, but we must bat on either through COAG or indeed through industry and sort this out. Which do you think is more likely, industry or COAG?
Oh, I think we've got to work with industry, and if that does work with COAG, I can't talk on behalf of the states, but I think what she's pointing out to is we are unlikely to see bipartisan support on emission targets, and I agree with her there, which then leaves it to industry and the bodies like Kerry running an Energy Security Board, hopefully working with the COAG. That would be a good thing. So I do think we've got to try and find alternative ways to actually set an emissions trajectory that we can work within. And really at the heart of Kerry's comments were that trajectory is very important for us to coordinate a response, and we'll do everything as we can as Origin to support initiatives that might take that there.
Frank, everybody's talking about the importance of a smooth transition. Can you explain why the dramatic fall in the cost of renewables at the moment has real implications for really hollowing out of power generation in both coal and indeed gas?
We talk about a smooth transition because what we've seen over the last couple of years is that if you have existing large plant leave the system, you must have supply that can replace it, and that supply we're seeking to have both obviously the lowest cost supply but also supply that's available to be dispatched as a combination over time. And no one wants to see those shocks because ultimately that hurts customers.
Which is what happened in Hazelwood.
Which is what happened with Hazelwood coming out. So when we do look forward about that smooth transition, what's actually happening is more renewables come into the system, and if I use solar as an example, solar runs in the middle of the day, and so you've got a large amount of supply that occurs in the middle of the day, and what they call is that it hollows out the energy market in the middle of the day in markets where there's high penetration for that. And if you're therefore running a coal plant, you're trying to run in a system that's moving up and down in a day, and that's not how those plants were ideally designed. So what we have to make sure is that we get that orderly introduction of renewables at the same time as having the right set of dispatchable plant that can cope with that move.
I mean, it sounds like renewables are progressing at such a pace, they're almost blowing up the business models of traditional power generation in say, coal. And actually this has implications because we thought they were going to all shut down at their technical life end, but they could have implications for shutting down way before that.
Kerry raised that there were technical lives, but with the influx of renewables, I think her comments were that there's risk that they may not reach technical lives, and I won't comment about whether or not that occurs or not. What I would say, though, is that it actually is challenging the existing plant in the system to respond to those rapidly changing circumstances as more renewables come in. So everyone is adjusting the way they operate their existing plants and modifying that, and that's an important feature, but that will become more challenging the more renewables come in.
You mentioned Hazelwood there, and that had a shock to the system. Now, the government says that's not the only reason that prices have gone up for customers. Indeed, there's been a lot of sort of rhetoric, government talking about particularly the gen-tailers making off like bandits. Are those comments justified, do you think?
Oh, well, I don't think the emotive rhetoric is helpful at all. I mean, what we have seen is a rapid rise in wholesale prices from very low levels, and that came in a fairly swift motion over 1 year, and that resulted in large price rises to consumers.
Are you saying there's no profit by industry taking as well?
It's a recovery of the wholesale price in the market, but no one wants to see the wholesale price rise as rapidly as it is. I think where there are comments more broadly made, and I think that there's some things that are sitting inside Rod Sims's report on the ACCC, which we wholeheartedly support, and that is around transparency in the retail market, comparison of offers, reducing complexity, and all of those things. Yeah, and all of those things, I think that there is absolutely further things we should be doing, and a lot of his recommendations we do support that go to that transparency and confidence in the retail market.
In the Royal Commission into financial institutions, we've had the interim report, and Kenneth Hayne has come down and said, look, really the problem isn't a need for more regulation, it's more about implementing existing regulation. I'm just wondering, because people talk about a Royal Commission into energy, are you worried that we're going to get a lot more regulation now in energy?
I don't know. I really think that there's been a lot of reviews already into the sector, and I think that they are very comprehensive. I mean, the ACCC report on electricity went over 5 to 10 years of data, and we see a lot that sits in there that's got 56 recommendations, and we support the implementation of many of those. So there's been a lot of scrutiny there, and before at Finkel and even in the gas market.
But do you worry about more regulation coming in, though?
I'm not so worried about more regulation. It's more about the implementation of what we've got. I think that's important. We have a lot of regulation. Remember, we're regulated at every state and nationally, so we've got enormous amounts.
So when it comes
but more reviews is what I don't think is going to be particularly helpful.
So, Frank, when we come to this issue of the default price that the government is introducing as a result of the ACCC recommendations, you were very careful around that. What do you think government means by a default price?
I think it came really out of the ACCC report, and I'll be really clear, and I think this was where we are very supportive. It's actually to be a reference price, and a reference price against which that everyone benchmarks their offers to market. It will give confidence in the comparison of offers to customers so that they know that that discount is anchored off something that is comparable. And the moment unanchored discounts mean that if you're getting 11% off one retail provider and someone's getting 11% from the other, you may be paying two very different prices in the same patch.
But are you concerned that with Angus Taylor and the big stick that he has, our energy minister, that if prices don't actually drop, that reference price might be turned into a cap by government?
I think we'll be under scrutiny as to the way we conduct ourselves, and that transparency we're fully supportive of. I think that if the industry doesn't respond to the way he likes, and I think the industry has responded, by the way, over the last 12 to 18 months, so I think that that's a key factor, then there's always the risk that more regulation comes in, particularly around price regulation, to which we're not supportive because that's where we've moved away from, and that is actually, I think, has a lot broader impacts in terms of competition.
And what would a price cap do for the gas market? A cap on retail electricity, how could it feed back into the gas market potentially?
Yeah, well, it depends on how that flows through to the whole stack of prices and how they do that. So it really does come down to and that's one of the things we've said, be careful about how it's set, because it must be set in a way that does enable the appropriate cost recovery and the appropriate margin so that you're getting the balance between competition and investment.
One thing that's been talked about as upsetting the balance is this overwhelming rise in the number of homes with their own solar, so off-grid solar
power. Now, there's still subsidies around it. I mean, what about the continued feed-in tariffs that are still there?
Some feed-in tariffs actually have remained, but some governments, for example, Queensland, took them off the customer bill and have been funding them on their own, on the government's balance sheet. There's still a feed-in tariff flowing through in the New South Wales system. But what we were talking about also was a federal rebate, because there's a rebate offered every time a solar's installed that gives a rebate off the construction, and that's the one that's continuing to rise as well. And that's the one that we believe should be unwound.
And has there been any response from government on this?
There hasn't been a response on that, but it was clear recommendation by Rod Sims, and we think that that's one of the other things that can occur across the value chain.
And Frank, what do you reckon is going to happen with Snowy 2.0, the government's great Snowy project?
I don't know. I mean, I think that, it's a very big project over a long time frame, and so we need to factor in the full cost of that construction and also the transmission cost that goes with it. So I'm not quite sure where the government stands on that right now, but we're interested to understand that.
Because presumably that decision will drive any decision of yours around the Shoalhaven pumped hydro project.
Well, it could have an impact on it. I mean, it depends on the market scenarios. It'd be one of the things we would consider in terms of expanding the Shoalhaven system, but not the only.
So overall, we've got COED coming up later this month. Do you think we will get some progress there?
Oh, difficult for me to predict, but I do think, I really do hope that the reliability obligation, which was worked through very significantly by everyone over the last 12 months as part of the National Energy Guarantee negotiations, I really do hope that they see that that's a good mechanism to put in. And we all said that it may not have been the ideal one at the time of design, but it is the one that was presented before us, and we all think it can be workable. And I'd be encouraging that that's where their conversation will be.
And that would be good for customers, but also good for shareholders?
It would be good because it would create a more enduring framework around what people need to meet as retailers on their reliability, which then enables us to have more confidence and that in terms of how we plan for that over time.
Frank Calabria, always great to get your insights. Thank you so much.
Yeah, thanks, Ticky.
And after the break, under scrutiny with 3 of the big 4 CEOs, bank CEOs, facing the Standing Committee of Economics this week. We get expectations from Fat Profit CEO Angus Geddes.
Now, back to Ticky.
Welcome back. Well, a big day for banking tomorrow morning at 9:15. CBA CEO Matt Comyn will front the House of Reps Standing Committee on Economics. Those hearings will give lawmakers a chance to grill the bank CEOs following the shocking revelations of the Royal Commission. Next in the firing line, Westpac CEO Brian Hartzer at 1:15. We'll bring you full coverage plus insights and analysis from 9:15 right here on Your Money. But what should we expect tomorrow from the proceedings? It surely comes at a pretty bad time for the banks. We revealed just last night that bank satisfaction is at an all-time low. For more, I'm pleased to welcome Angus Geddes, CEO of Fat Profits, to the desk. Angus, how do you see the value? Welcome. How do you see the value of the banks at the moment?
Look, they're cheap. They're definitely cheaper.
They're cheap.
They're definitely cheaper than where they were, say, 6, 12, 18 months ago, when CBA was priced at 4 times price to book. But they're still relatively expensive compared to, say, banking stocks in Japan. Or in the United States.
Are they becoming, just by the very nature of the fact that they're selling off some of their other non-traditional bank assets, more comparable now?
I think they are. They're becoming more simplistic, straight-through banking models.
Yes.
But of course, there remains a number of headwinds. I don't think we're quite out of the Royal Commission quagmire. Were
you surprised at the sort of provisioning that's gone on?
I have been surprised, and there's probably more to come. So I don't think there's any rush to be, charging back into the bank stocks just yet. Yeah. But look, they're definitely on our radar in buy territory, and there is going to be an inflection point at some time, not too soon.
Yes, yes. So you're looking at what, the provisioning? You worried about the wholesale market and margins and that sort of thing as well?
Yeah. Look, I'm worried about the housing market. Yes. The housing market's been coming off, and I think why we see, when we continue to see, Melbourne and Sydney continue to decline. There's going to be caution around the banks. But look, the rise in interest rates overseas is probably a positive thing. We're seeing, the banks are passing through higher wholesale funding costs, and that's going to positively impact their net interest margin. So, look, I don't think it's all too...
Internationally.
Internationally,
yeah.
and I don't think it's all doom and gloom.
Yeah.
And if you're bearish...
You like the Japanese banks?
We like the Japanese banks.
Why do you like Japanese banks?
Well, look, they're a quarter of the price of the Australian banks.
Are they now? Yeah.
And believe it or not, after, a 30-year bear market, I think that's probably over. I think interest rates are going up in Japan.
Really?
Slowly but surely.
Yeah, yeah.
And, a lot of those Japanese banks are priced, for almost sort of Great Recession prices.
Now, you have got quite an eye on Bank of Queensland. Why is that?
Well, I think they're relatively insulated. They're a regional bank. We like Southeast Queensland, believe it or not. They had their...
As a sort of growth
Well, I think the property market's got less risk. During the GFC, the property market went down by 50% up there. And, the banking sector was in trouble, whereas we haven't seen the same level of excess work its way into Queensland. So I think, relatively speaking, it's a safer bet.
Okay, all right. But beyond banking, you think gold's actually looking all right?
Well, yeah, it's a contrarian view, Ticky. But yes, I think gold looks really interesting at these levels.
What is it at the moment, by the way?
It's around $11.93 an ounce, and we quite like the Australian gold producers. But if you think that interest rates are rising on the back of wage growth and inflation overseas, then that's got to be good for the gold price.
Yeah, yeah. So who do you like, miner-wise?
We like Evolution and Saracen.
Yes.
And they're very under-owned by the fund management community, which means you've got to be looking now.
Right, right. Well, gosh, I haven't talked about gold for a long time, but you actually see going out gold as, quite a good...
I think it's going to be quite a good bet because at the moment, the dollar's very over-owned globally.
Indeed. All right, well, nice to finish with a gold bug. Andrew Geddes, thank you. Angus Geddes, thank you very much.
Thank you.
That's all for the show tonight. Tomorrow night, Energy Minister Angus Taylor. I'll be catching up with him at the sidelines of the Outlook conference in Melbourne, supported by the Melbourne Institute and the Australian. Until then, thanks for your company.